As we roll into Tuesday, the market is starting to show signs of pushing in a particular direction, and that direction is one of risk off, dollar off. For many years, risk liquidation flow is correlated with safe haven demand for the US dollar, but now this correlation will be tested in new ways in light of US administration's soft dollar policy. At this point, it's too early to tell, and it's possible that any signs of a more accelerated rise in US inflation will more than offset US dollar outflow from soft dollar policy, on the implication that the inflation surprise will force the Fed into a more aggressive rate hike timeline, which will favor US dollar yield differentials. But right now, the focus continues to be on global risk sentiment, and the state of the equities markets is best reflected through US stocks. We have seen a relentless pattern of U.S. equities getting bought up aggressively into setbacks over the past near decade, and if there are any signs that this pattern could be broken, the expectation is that it will be broken in spectacular fashion, with investors running for the exit doors. The reality of monetary policy normalizations is upon us, and this process has moved into a mode where momentum is picking up and the wheels are starting to really turn. And when we talk about the negative risk impact of rising inflation, we reference inflation levels in all major economies. This means signs of a more rapid uptick in UK inflation are also important as far as giving us an indication of where we may be headed. And with that said, we'll be reading today's UK CPI and producer prices readings with added interest. Anything on the hotter side of expectation could very well inspire deeper setbacks in the global equities market. That's all for now.